So in a recent exchange on Twitter, Cathie Wood and Elon Musk both made some big statements about passive investing. Elon said that there should be a shift back towards active investment, and then Cathie added that history will deem the accelerated shift towards passive funds during the last 20 years as a massive misallocation of capital. Now, those are some pretty bold statements coming from some very well-known faces with a lot of influence. However, are they right when they say this, or are they just misunderstanding the problem and twisting things to suit their own beliefs? Personally, I think they're wrong, but that's not a good enough answer, and it's not quite so simple. You deserve to know why, and we should really take a look at the data to hit back at some of their points. Oh, and also, you see this picture here of a fighter plane with red dots on it? I think I can use it to explain some of the story later, but it's not what you think. When we talk about passive investing, we're talking about putting your money into low-cost, broad market index funds. These funds then put your money to work by buying the stock of companies based on how big they are. So popular index funds, ones that track the S&P 500 for example, will take your £100 or $100 and split it between all of the companies that make up the index. It's pretty much all done automatically. So it will flow into buying stocks like Apple, Google and Microsoft based on their percentage size. Makes sense, right? But investing like this hasn't actually been around for very long, and it's only really become popular in the last couple of decades, rising to fame through people like John Bogle, the late founder of Vanguard, who actually created the first index fund that regular people could invest in. The idea behind the index fund and passive investing was that the alternative was providing a really bad service to investors. The money managers on Wall Street, the brokers and the fast-talking salespeople were all charging hefty fees to regular people like you and me, but in return were getting pretty poor results. The average person only really had a couple of options: try and pick stocks yourself or invest in mutual funds that were actively managed and claim to give you good performance and work hard for your money. The reality, unfortunately, was just the opposite. High trading fees, high commissions and management fees all added up to pass on just a fraction of the market's performance. If in 1 year the market returned 10%, the average investor might receive 6 or 7% back once you account for fees and poor performance. The average investor was losing out big time. On the other hand, with passive investing, the concept is a lot better for us regular investors. We get the full return of the market with only a much smaller cut taken out for fees. If the market returned 10% for the year, our return would be 10% minus fees, and those fees were only a small fraction of a percentage point, then we ended up with a lot more in our pocket to grow over the years. Unsurprisingly, when the index fund was first coming to market, Wall Street money managers hated them, especially because they were taking their high fees and commissions away from them. There was even advertising campaigns calling the index fund un-American, as if somehow you were giving away your money to the wrong people or investing in the wrong way. Is it time to explain the fighter plane picture just yet? No, not just yet, hold on. But it is time to hit the like button if you've enjoyed content like this. It really helps the video get out to more people like you. But anyway, back to the video. Even with their big budgets and hatred for passive investing, this way of growing money was set for a meteoric rise into what it is today. Just take a look at this data from Bloomberg. The passive investing market is now worth more than half of the entire US equity market. Out of the $11.6 trillion worth of value, passive investing makes up 54% of this, making it a $6.2 trillion business. Now, most of this is in index funds, tracking indexes like the S&P 500 or the total US stock market. And I'll bet that even if you aren't investing right now, I'm sure you've got a stake somewhere through your pension at work that you probably don't even realise. Hang on though, this all sounds great, but isn't this video meant to be about the problems with passive investing? Elon Musk and Cathie Wood clearly think there are lots of problems. Why would two highly influential people not be fans of passive investing and criticise the very thing that's revolutionised investing for the average person? First up, let's deal with the market weighting. The concept of an index fund is that it allocates money to a company stock based on its size. The largest companies that make up an index, like Apple in the S&P 500 for example, will get the biggest share of your cash, which currently means that for every $100 or £100 you put into the market, Apple stock gets nearly 7%, Microsoft almost 6%, and Amazon 2.8%. It sounds fair, but critics would argue that large companies keep getting inflated valuations regardless of their performance or prospect because of their size. Imagine a world where we only invested passively from now on. Money that you might invest every month would keep going in to buy the same companies every time. But what about all of the smaller companies who are growing faster, being more innovative? What about them? Well, here's the first issue. Clearly, if everything was purely passive, you could argue that there would be issues, but then that's not the world we live in. In a free market where you can invest in whatever you like, there's still a huge amount of opportunity for active managers to choose companies they like and for individual investors to do the same. If anything, active managers should have an easier time finding bargains if they really think that all of the passive money is going into an already inflated stock market, because they can spend more time looking more closely into the fundamentals of the companies. I just don't agree that passive investing in any way stops active investments and active managers from trying to beat the market. And if there's money to be made somewhere, you can trust that people will follow the money. If anything, the active manager should be making a killing right now, but let's touch on that later because clearly it's not that simple. The second point we need to cover is this one. Cathie Wood said that passive funds prevented many investors from enjoying a 400-fold appreciation in Tesla stock from its IPO to when it got into the S&P 500 in June 2010. On the surface, this sounds like a solid argument, and it makes sense that unless you own the whole US stock market, you wouldn't have even had Tesla in your passive portfolio if you were just in the S&P 500. However, it's not that simple. Tesla's a great example in hindsight of a stock that everyone wishes they had invested in. It's like Bitcoin back before the run-up in 2017. Everyone wishes they had held on or just put money in. Hindsight's a wonderful thing for investors, and we're all guilty of wishing we'd done things differently. However, the reality is not quite as rosy. We've no idea what the future holds, which companies will succeed, and which new industries will change everything forever. It's only clear once the winners emerged that there's been plenty of losers along the way that we get to conveniently leave them out. Check this out. Back in 2010, Tesla delivered 1,500 cars back when they only produced the Roadster. Do you remember that one? Is that the kind of company that you would go all in for and invest your money? I mean, it sure looked cool, but as investors, we needed a bit more than just a concept. Also, look at the financials and the way the share price has risen. The company only started becoming profitable recently. In fact, 2020 was the first year the company delivered a positive net income number. Even if you look at free cash flow, the company only delivered a positive number here in 2019. I mean, in his own words, Elon Musk said the company nearly went bankrupt on a couple of occasions. So the success of the company was no way a dead certain fact. Now, this is where the picture comes in. It's a great story if you've never heard it before. As I mentioned, this is a US bomber plane from World War II, and the red dots on it are all from places that bullet holes were found on the planes, which had made it back to base. Military chiefs wanted to know how they could improve things, so they worked with an Austrian-born academic called Adrian Wald, who had escaped the Nazis and lectured at Columbia University. At first glance, the answer would be a simple one, and the military assumed that Wald would tell them that they needed to reinforce all of the areas covered in red. But wait, his actual response was something a lot more ingenious but simple at the same time. Wald realised that the data he was looking at was incomplete. We only had the planes that survived, not the ones that were lost. His conclusion was that the armour actually needed to go on the places that weren't hit, because clearly they were the most important. The engines and the cockpit, for example. It was a clear case of survivorship bias, quite literally in fact, which means that you need to be careful about jumping to conclusions with the data you have in front of you and consider the data that you don't have. See how this might be relevant to Tesla? One thing I'll give them though is that passive investing will have some major hurdles ahead when it comes to corporate governance. Elon specifically mentioned that John Bogle did have concerns about passive investing just before he died in 2019, and he is right. Bogle was concerned about company ownership falling into the hands of a small number of index fund providers, which includes his very own Vanguard organization. You see, if you check out any of the largest companies in the US, let's just take Microsoft for example, you'll see that passive investment has caused ownership to look almost exclusively like this. The top owners are Vanguard, BlackRock, State Street, T. Rowe Price, Fidelity, and so on. But essentially, they're all the largest providers of index funds and mutual funds in the world. So as the passive investing world grows, their ownership in companies grow, which means that their voting power also grows with it. These small number of companies have enormous power on company boards, and in theory, could control and manipulate them to suit their own needs, but not in a good way. You see, you want a free market and fair competition in an ideal world, but at the moment, some of the world's largest companies that compete with each other, think of different airlines or maybe payment providers like Visa and American Express, or restaurants like McDonald's and Subway owned by Yum Brands, they're pretty much all owned by the same few names. Now, as a company owner with a duty to my shareholders, should I know what my competition's doing and have a stake in both? Should I make massive changes in one company that would have a negative effect on another, even though I'm the major shareholder of them both? All of these issues are yet to be ironed out, and they'll have major consequences over the next few years and many decades to come. This is easily the biggest issue with passive funds, but I've got no doubt that people a lot smarter than me can figure these issues out, because I'd rather have these problems than have no option for regular investors who want a low-cost way of investing. So have these two got this completely wrong? Is passive investing really a problem in the world? Do we need to go back to the days of active investment? Well, just remember that we're yet to see any data to prove that active management benefits investors in the long term. If you watch my channel regularly, you'll know some of these facts already, but check this out. In 2021 alone, an amazing year for the market that we can pretty much all agree on, nearly 80% of actively managed funds failed to beat the returns of the market. So, in one of the greatest bull markets of all time, when there was money pouring in from all sides, fund managers with all of their smarts and analysis, they still couldn't find the winners to bet on. The long-term results don't get any better, and it only leaves us with a select number of individuals and companies who have actually performed over the long term, who we then get to idolise for the foreseeable future at least. But, good luck also finding them. Choosing an actively managed fund that will perform better than the market for the next 20 years is anyone's guess, even if that person could be Warren Buffett. Ultimately, Cathie Wood is a fund manager with very speculative bets on companies in their portfolio that could do very well in the future. It's very hard to disagree that all of the innovative areas that she focuses on, like AI, robotics, and blockchain, won't have major impacts on our lives in the future. The problem is, we've got no idea which companies will be the ones to succeed. Lessons from the dot-com bubble should have shown us that you could have hundreds of businesses fail, even though we knew that the internet was going to be one of the greatest catalysts for change since the Industrial Revolution. Just because an industry will grow 100% every year, it doesn't mean that all the companies who compete in it will. In fact, most will probably go out of business. And look at how quickly things can happen. Blockbuster or Toys R Us, anyone? And we've seen at least the crazy ride that ARK has had over the past few years. However, you can almost guarantee that nearly every investor, and certainly the average investor, has lost money in a fund. It was the same many years ago with Peter Lynch's Magellan Fund. The money comes pouring in after the great performance, and ultimately, the outperformance can't continue forever. As Bogle would say, everything would end up reverting to the mean average eventually. It's in her own interest to say that active management is the way forward. And with that, all I would say is prove it. Show everyone how wrong passive investing is by your performance over the long term. You're completely free to do it. Good luck. And to Elon's points, I'm afraid he's misunderstanding Bogle's concerns before his death. His issue wasn't about prices being manipulated by the passive funds, it was in corporate governance and management, which is a problem but not something that active management is somehow going to magically fix. These are very much separate issues. In the normal world, neither you or I are billionaires or multi-millionaire fund managers. We just want to make sure that our money grows by investing in the long term. If you want to retire early or make sure you've got a comfortable living in the future, passive investing has proven itself to be one of the only viable options to get the returns of the market and keeps on consistently beating the professionals year after year. Bogle knew this, and so do the professionals who try and squeeze you for charges at every possible chance they get. Passive investing is going to have its challenges, no doubt, but this isn't because passive investing is bad in itself. It's just that our current institutions are not set up in a way that reflects how we invest today. And let's not also forget that there's no reason both active management and passive investment can't coexist nicely together. I certainly do a bit of both, and like I said before, if there's money to be made somewhere in the market, people will find a way. Thanks so much for making it this far. If you are more interested in passive investing and looking at some of the best index funds you can invest in here in the UK, then watch this next video where I discuss some of the best ones available. Or, if you aren't based in the UK, you might like this video where I compare some of the returns of the S&P 500 to a selection of different indexes and combinations of funds. You might be surprised by the results. Anyway, drop me a like if you've enjoyed the video, subscribe for many more, and as always, happy investing.